You mentioned the Knicks are back in the finals tonight. They played the Spurs the last time in 1999. Yep. That was the raging bull market in the triple Q. And I think the Qs were up 78% that year. But the manner in which implied volatility on tech stocks is rising now as the stocks rise even outdoes that period, which was an epic kind of inflation of prices. And so the point I'm trying to make here is that it is incredibly unusual and unprecedented the extent to which these chip stocks, memory stocks are rising so strongly and their implied volatilities are rising. The stat I want to point out is that the Kospi, which is kind of the center of the storm, it's got SK Hynix in it, it's got Samsung in it, it's up 135% this year. And 2-month options, the implied volatility started the year at 28% and is now at 70%. There's absolutely no historical precedent to something that is that protracted, even bringing in the tech bubble from the late 1990s.
I feel like I need to hedge some of that stuff. Are your clients, are they buying risk or are they buying kind of insurance here?
Yeah, I always go back to the quote from Soros. He said, "When I see a bubble forming, I rush in to buy it, further adding fuel to the fire. Don't short the bubble, buy the bubble, and kind of deal with the consequences later." And I feel like, I'm not saying that we're in a bubble. The earnings absolutely justify this. What we've had is this explosion of earnings across the entire complex, especially in tech. I think S&P earnings are up 28% year over year. These are incredible numbers, but they are underpinning a feedback loop, which is some function of psychology.
Right.
It's some function of the products that are created in the market. I pay a lot of attention to the leverage ETF complex. There is some wild stuff going on in these leverage ETFs.
And what's important here, to Paul's point on hedging, do you develop a strategy, or is the Dean Curnutt hedge to not own them?
That's a really interesting question. Do you just go to cash, or do you pay some money for actual insurance? And I think it's a little bit of a combination of both. I mean, first I would say, boy, it's impossible not to be long, especially U.S. markets. We have a very benchmarked system. In other words, you can call yourself an active stock manager. If I look at your returns and sort of correlate them to the S&P at large, you're not really deviating that much. The cost to deviation from the benchmark can threaten your business, especially when the high flyers are doing what they are. There is some optionality in cash. A 4% 2-year note, that's not bad. That's not a bad place to hide out. But I like actually paying some money for insurance. And with the VIX down here at 16, which, by the way, I'm not saying it's incredibly low relative to the daily fluctuations. The VIX is at 16 because the S&P is not really moving. We're down 20 basis points today. The daily swings are 40, 50 basis points at best. That's nothing. So it doesn't really argue for a tremendous amount of hedging, in terms of the daily motion. But I would say those hedging costs are down considerably from late March. And you've had the opportunity to pay for those hedges very easily just via the gains. You're enjoying so much gains in the market that, to me, the prudent thing to do is just take some chips off the table by spending a little bit of money on puts and put spreads on the S&P.
Are you surprised the VIX isn't higher? Because as you mentioned, I guess the daily variations aren't that great, but boy, it feels crazy out there.
Right, it is. And so here's what's going on. And this is, again, really fascinating. The VIX is not that high because the daily swings are not that high. And yet, as you say, Paul, there's so much going on. These stocks are moving 15, 20% on the upside each day. Intel, SanDisk, Micron, just take your pick. What's happening is this unprecedented amount of diversification in the index, zigging and zagging. And there's a great function, a little plug for Bloomberg, VCA, the VCA function. You get all your information on implied volatility. I'm on that command every day. And it'll tell you that the anticipated correlation of stocks in the S&P over the next month by way of option prices is 6%. There's never been anything like this. So even though the stocks are moving, there's so much diversification that it's muting the overall level of S&P movements. And I think we just have to prepare for the eventuality of a macro shock that moves everything at once. We had a little bit of that in the oil shock, and I just think the market's giving you a chance to hedge that again.
I want you to talk to the people listening to Bloomberg Money this Friday. They don't know alpha from beta. They don't know hedging. They don't know 1 month this, 3 month that. How do they mentally hedge a conservative portfolio, a retirement plan? Just close your eyes and hope?
Well, I think there's the old saying, timing in the market versus time in the market. You want to be in the market over long periods of time. That's when compounding of returns really works. So you just don't want to get yourself trading in and out. I think it's proven to be largely unsuccessful, the ability to time the market. You want to be risk aware. You also want to understand that this bedrock of institutional portfolios, 60-40, right? 60 stocks, 40 bonds. That just doesn't work the same way as it used to. Even as I'm telling you that the correlation across the stock market, these stocks are very uncorrelated. The correlation between the stock market and the bond market is very high. And it's very much linked to oil. Oil is throwing a wrench in so many efforts at diversifying your portfolio because everything is linked to oil, inflation expectations, the path of interest rates, and so forth. So from a diversification standpoint, 60-40 doesn't work as well. So you have to just recognize that. And again, that to me argues a little bit more for being not fully invested right now. And again, I think that's some combination of just having some cash on the sidelines, which relative to a decade ago when there was a 0% yield on cash, now you get 4%.
Yep.
That's not bad.
Dean, we're going to get kicking off tomorrow, as has been reported, SpaceX IPO.
Yeah.
And then we're going to have presumably Anthropic and OpenAI behind them. Gajillion-dollar IPOs. Major impacts on the indexes. What's your understanding of how the indexes are going to deal with these companies?
Right. So I know that the NASDAQ is kind of fast tracking the SpaceX IPO, trying to make room for it. There's a lot of game theory around what the indexers will have to do, where that supply comes from, where the capital comes from.
What do you think they'll do?
I honestly, I can't really say for sure. I think it's hard to know. I think the SpaceX one, at least as I understand it, this valuation is so high. I can say that they're going to list options 2 days after the IPO, which is really fast. And I think you're going to have a $1.5 trillion company with options that have an implied volatility of 100. And that's crazy. It just speaks, and Anthropic and OpenAI are going to be similarly incredibly volatile companies with incredibly high market caps.
So when Sweeney gets his 8,000 shares, this puppy pops at what, 175?
Yeah.
Or 135 is a chance,
Right.
whatever it is. They do the options 2 days later. The stock at the bid goes down, and somebody steps in because there's retail enthusiasm or whatever.
Right.
How do you play that in the option market?
Right. So what I'm saying is that the uncertainty around where this could go. So you could get there's just not enough supply, and the indexers are forced to do what they have to do, which is being price agnostic and buying. That could lead to significant rises in the share price. And yet the valuation seems so high, and I've done enough reading on it to think that people are skeptical of the valuation holding, that it could go also down a lot. And that's where you're going to get this very high volatility level. You could easily see, and perhaps, Paul, you're one of them, that folks are looking at the incredible returns from having been a pre-IPO investor and saying, you know what, let me take my money if I can. There could be a lot of that. It's just going to be extremely volatile. And I think the big picture is that SpaceX, Anthropic, OpenAI, it's a new breed of company. And these are trillion-dollar companies with incredibly volatile daily swings. And again, I think back to the retail investor, you got to know that today's S&P is just not the S&P of a decade ago or 20 years ago. It's the components are just much more volatile, and you have to be careful.